later. Thank you for tuning in nice and early. We are going to wait just a couple of minutes here to go live on all the different platforms. We are streaming this live on YouTube, Facebook, and LinkedIn. So give us a second to go live everywhere and give everybody a chance to tune in. What we do on these trainings every Tuesday and Wednesday at 7 p.m. Eastern is go through our different training topics here so you can tune in. But we'll wait just a few minutes to get started here to dive into today's topic. In the meantime, we put the chat up on the screen, so feel free to drop a comment there in the chat as you tune in. And I see some people are already dropping comments, so thank you there for the comments. Looks like we got Christina, Chrisita, Harriet, Dennis, Christian, Orlando, Jerry, Julio, Adam, Julie, Dario. Thank you for the comments and tuning in early. Jason, the other Adam. Appreciate that. Keep dropping comments there while we wait to get started. Arjun, appreciate the comment. Thank you, everyone. And it looks like we are live on all the different platforms, so we can go ahead and get started. But as you tune in, keep dropping comments there and feel free to drop questions there as well as we go through this training. We'd love to answer some questions at the end of the training. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender specializing in non-QM loans. And what we do every Tuesday and Wednesday at 7 p.m. Eastern on these loan officer trainings is pull up a different loan topic and do a deep dive into it. So our sales manager, Jose Gonzalez, has 27 years of experience as a loan officer and a realtor. So he will go ahead and do a presentation here on today's topic, which is asset utilization loans. So being able to utilize somebody's assets to be able to get a mortgage loan. So this is a great loan that I think is really overlooked a lot of the times when it comes to using it as an option. And you're going to see why here when Jose pulls up his presentation, that there's all kinds of cool benefits to it. And it's another great tool in our tool belt as loan officers. So with that being said, I'll go ahead and turn it over to Jose here so he can pull up his presentation. And I guess first off, we can just talk about what a asset utilization loan actually is. So go ahead, Jose.
All right. Good afternoon or good evening, everybody. Thank you for joining us for tonight's training. Great to be with you this evening. So I'm on the East Coast. So asset utilization, great program. Like Kyle was saying, it's an underutilized program because it blows most people's minds to think that you could actually qualify someone with just the liquid assets that they have available, right? But that is the key. Now, this type of program, like I mentioned this morning, because this was our rates topic this morning, used to only be available like at the larger investment houses like Merrill Lynch, Payne Weber, and all the other places that would hold your stocks, right? Your brokerage houses, trading houses. They would let you borrow based on the amount of your stocks or bonds, your investments, but you would essentially be, pledging them, right? So they would sort of be tied up, right? You got to leave it at that amount, and if it dips below a certain amount, then you could have some repercussions like margin calls and all that on your loan, right? But the asset utilization option that we are talking about, right, is not that one. It is one that just lets you use the assets without pledging them or anything like that. They just have to be liquid assets. That's the key, right? It has to be in some type of an account. Now, it cannot be crypto, unfortunately, because the way that most of the crypto accounts are not and cannot really provide a real statement, real bank statement showing the kind of activity. And crypto is so volatile lately with everything that's been happening. So I don't see crypto being an option anytime soon on asset utilization, but you can use a lot of other type of assets. They just cannot be, for example, stuff like artwork, fancy paid off cars, other real estate, because those are pretty much illiquid. Yes, you can sell the artwork pretty quickly if you take it to an auction house and give it away for less than market value. Yes, you can sell your car and your property pretty quickly too. But when they're determining the value as to how they're going to use the assets for income, it has to be something that historically is liquid, right? I mean, they will let you go as illiquid as 401k retirement accounts, right? Which tend to have different reasons when they will or will not let you distribute from the asset. But, and from there, you can work your way up to stocks, bonds, mutual funds, cash, money market accounts, savings accounts, checking accounts. That's really what we're looking at. So yes, and the best part about it is that you do not have to pledge the asset in any way, right? It's you just have to show it. I'll get into the specifics on it in the presentation, but you just have to have it available. It can even be used as supplemental income, not as the main source of income for the borrower. So, a lot of different ways you can use it, which I'm going to get into now shortly. So let's go ahead and share what we got here, and we will get into our presentation. There we go. So asset utilization loans. Now they're also referred to uh, in some instances as asset depletion loans. So that is used interchangeably depending on which investor you're looking at, which is the conduit where the loan is going to be sold to, if we're the lender, or brokered to, if it's a wholesale transaction where we are not the lender. So, first and foremost, just a little rehash of what we just went into. What is an asset utilization loan? Well, like I stated, a loan that uses the borrower's liquid assets to determine the qualifying income. So checking, savings, money market, stocks, bonds, mutual funds, annuities, right? 401k and other retirement accounts. Best of all, no tax returns required. And you'll see why in a minute, why that could be a big benefit of not having any tax returns required. So, who qualifies for an asset utilization loan? Well, you can U.S. citizen, of course, permanent resident alien, which is permanent resident of the U.S. with their green card, non-permanent resident alien with U.S. credit, right? So I always like to remind everyone what a non-permanent resident alien is. It is somebody who is doesn't have their green card, of course, or else they'd be a permanent resident alien, but they have every other benefit as every other U.S. national, because the non-permanent resident alien is living full time in the U.S., working legally in the U.S. They usually, well, they will need a work permit, or they may have a work visa. You get this a lot of times. The specialty workers, like in the tech industries or in nursing, for example, you see that a lot, where they come from other countries, and due to a shortage in this country of those specific jobs or those specific workers, they give them a special visa that automatically includes a work permit with that visa. Then they also are issued a social security number, because they're going to be employees. They're going to be receiving W 2s. And in order to receive a W 2, you need a social security number, not an I-10. So non-permanent resident aliens have all the benefits of a U.S. national borrower, and of course, they need to have the U.S. credit. First-time home buyers are okay. Some options even allow for an I-10, which is pretty cool, right? I mean, they're not going to discriminate if they have the assets. But where they do get a little picky is with the foreign nationals, right? They do want to limit them a little bit more. And the main reason with that is because a foreign national does not live permanently in the US, does not derive any of their income from the US, and typically holds most of their real assets outside of the US. So this program is applicable for US based assets only, and not applicable in general for foreign national borrowers. But you got a lot of options there, including an I-10 borrower. But a lot of you didn't know that, right? So, when would an asset utilization loan be the best option? Well, that's pretty obvious, right? Your borrower doesn't qualify through any other asset, any other income determination. Either they don't qualify because they don't have the income showing on their tax returns that they need, right? It could be either because they are unemployed by choice, underemployed, just don't have the income on their W 2 job, or they have a tax return and they're self employed and they don't really care to show all of their income. Or in some cases, for high net worth individuals that are very private with their paperwork, they may not want to disclose their income nor their tax returns, because in their tax returns you may have a lot of proprietary information, and like the businesses that they own and all that kind of stuff that they feel if anybody finds out what they're doing, they may lose their competitive edge. So they really don't care to whatever they have to do, as long as they can get approved in this manner, which is less intrusive to them, right? Very little stuff. I mean, yeah, they got to show their assets, but they don't have to show any of their businesses, nor business income, nor business activity, or anything like that. This is very good. For example, if you have individuals getting paid in stocks, we do get people, excuse me, especially with like newer companies, or maybe high level executives, that the majority of their income may actually be in stocks and not in W 2 earnings. Well, CDFI, which is our no income verification option, may not necessarily be always the only option, because our asset utilization option goes to a higher LTV than the CDFI no income option that only goes up to 80%. On our asset utilization option, on a primary, we can go up to 90%, with the best options being at 85%, but we still can go up to 90 without a 12-month reserve requirement. I mean, they're going to have their money, their assets there anyhow, but the CDFI has a few other hoops of fire that make you jump through. So keep in mind, individuals getting paid in stocks, asset utilization, or you have your retirees that have a large portfolio but limited retirement income. Maybe they saved their whole life, 40 years, 50 years. They have a hell of a nest egg, two, three, four, $5 million, right? In a 401k and in some annuities, but they may only be getting $2,000 a month in Social Security, or maybe between, if it's a couple, maybe 3,500 or maybe 4,000 a month. But that's not going to get you very far with the prices that we have in most of our markets, and especially if they want to get a nice property that may be $1 million or more, and they're looking at a $8,000 a month payment, right? So they'd have to have definitely $3,000-4,000 a month when you cut it. And also, one very interesting use is that asset utilization can be used as supplemental income in two cases. And we have, in our non-QM scenario, is we have one really cool option that just got released, that if your borrower is full doc, right? If you're going full doc on your borrower, and remember, full doc can be bank statements, can be P&L, or can be traditional full doc. We're not just talking tax return full doc. So if your borrower is going full doc according for non-QM, and the DTI is 60% or less, then you can actually get the excess money that you have available. In other words, the money left over after the down payment, after the closing costs, and after the reserve requirement, whatever is left there, divide by 36, and you can use that to supplement the income, try to bring it down to 50% or less. That's a cool little twist that just came out. And we do have the people that do have the extra money. So sometimes rather than saying, darn, I want to have to put down an extra $50,000, well, if they had that extra $50,000, right? Let's just do some quick math here. 50,000 divided by 36, that's $1,388 more per month. There is no minimum amount of assets that could be used that would have to be provided for this supplemental income option. So sometimes if you're just a little bit off, this could be the way to go. And there's another supplemental income option is for retirees 62 years and older. Freddie Mac will allow you to use asset utilization also to qualify. So look that up in the Freddie Mac selling guide. That's a pretty cool twist. Most people don't know that exists. That could definitely come into play for your retirees or borrowers 62 years or older that are on the way down regarding the income that they're earning, but they definitely have a lot of assets. Well, that's a good option for them. So, what are some of the credit and asset requirements for the asset utilization program? No pun intended. We can go to credit scores as low as 600 as long as your LTV is no higher than 70%. So that's a pretty good option considering most people think that non-QM dies at 660 or definitely below 620. You can go down to a 600 for this option at a max 70%. With your max LTV at 90%, this obviously is for primary purchases. Investments are going to have lower LTVs. But as I did mention, the best options regarding rate, if you recall from this morning's show, are going to start at 85% LTV and below. Reserve requirements are as low as 3 months. But most are going to be 6, but they're as low as 3 months. Some options do not have a trade line requirement as long as 3 credit scores are present. So again, when we're talking always in our trainings, where we state, be aware of what's in the credit report. Don't just look at the credit report just for the credit score, right? You got to look at the trade lines. You got to look at other things like disputed accounts and everything, but especially this particular option where, we have options that do not require a minimum trade line requirement if you have all 3 scores present. That's not every asset utilization option. You would have to look at the guidelines because they are all individual guidelines for each option. Another thing to be on the lookout for is that some options can limit the asset percentage that can be utilized on retirement accounts. Now, some let you use 100%, others may limit you to 80%, or others may limit you to 70%. The main thing to take away from this is that there can be a limit. So make sure that you review the guidelines of whatever option you're considering to make sure that you can meet all of these points. Because again, we don't go with an option just because of the rate. Obviously, rate is one of the primary things that would attract us to any particular option. But once you look at the first 2 or 3 ones that have the best rates, then make sure to see which is the best guideline that your borrower is going to be able to meet all of the points. Another thing to be on the lookout for in these guidelines has to do with seasoning of the asset. In other words, the asset that is being used for determining the income has to have a certain amount of seasoning time that the borrower has been holding that asset. Uh, in some cases, it's 4, some cases, it's 6. It does varies. So always consider seasoning of the asset. And again, we're not talking about the asset for the down payment. We're not talking about the asset for the closing costs, nor even the asset being used for the reserve requirement for the loan. We're talking about the assets being used for the income, because the assets for the down payment and the closing costs and the reserves are going to be deducted from whatever is going to be calculated to determine the income. They're not going to let you double dip like that. And another point is, really important, be on the lookout for minimum asset amounts when using assets for the main income. What do I mean by that? Well, in some cases, they may say the minimum assets that they'll consider somebody having for asset utilization purposes is $1 million or more, or a certain percentage, a certain amount of the loan amount, right? So they have different ways that they look at that. So don't be caught off guard when all of a sudden you submit your file to underwriting. You didn't look at these. Be on the lookout points and I'm telling you about, and then all of a sudden they hit you with a condition and you wonder, where did that come from? Well, it was probably one of those uh, guidelines that you didn't look at when you got so happy that you just found the low rate. So it's not just about the rate, it's about the guidelines. So, what are the properties that you can, and what type of LTVs? Well, obviously, single family is going to give you the max 90% for primary, 85% for investment. On single family, I'm talking about one unit. You can do PUDs, you can do warrantable condos. 2 to 4 units are possible, but there's going to be an LTV adjustment on the primary. It's going to be max 85% and max 80% on the investment for the 2 to 4 unit purchases. You can do modular homes. A modular home, again, I like to always state, is not a manufactured home. So modular homes tend to look just like regular homes. They just have parts of the components are built pre-manufactured, and then it's put together at the site. But it's not like a manufactured home that comes in 2 pieces, trailer to the site. They bolt it together, affix it to the ground, and then you have a home. That's not what a modular home is. Some of the ineligible properties, obviously, we got to look at properties in fair to poor condition, geodesic domes, ALFs, properties on large acreage. Some of our options do allow up to 20 acres on this product, So, this is a little less restricted than DSCR. But if it's anything above 20 acres, for sure, not going to be possible. And even if it's less than 20 acres, it's not possible in every option either. So you do have to look closely at the guidelines of the option that you're considering working with to make sure that large acreage isn't going to be an issue. And of course, unique properties. They don't want the only type of property in an area, because then they may consider that some type of an obsolescence and that it could affect the resale of the home. So definitely, if a property is you consider a very unique property, definitely run that by the AEs of where you're thinking, if you can't find the answers in the guidelines, to see if that's going to be an issue. Right. So here is the very interesting part, right? Last but not least, is in our income calculations, right? Now, again, asset utilization loans are non QM loans, right? Non QM loans do not sell to the GSE agencies. They do not sell to Fannie Mae. They do not sell to Freddie Mac. They do not sell to Ginnie Mae. They sell to Wall Street. They sell to life insurance companies. They sell to pension plans. They sell to hedge funds and a number of different finance related companies. But the main point to consider there is that all of those companies are going to have their own guidelines for the product that they want to buy. They set the guidelines, and then those guidelines tend to travel downhill till eventually they get to us as the lenders offering the product. Uh, we could be selling that product to our investor, but then that investor is going to be securitizing that loan. So that's why you get all of these different guidelines. Now, every now and then you get a couple of our investors that may securitize with the same outlet. So you may see a similarity in the guidelines. Sometimes they're exactly the same, right? But most of the time, and I would say 9 times out of 10, they are not the same. They are different, and it's going to vary from option to option. So, some of the specifics that two of the usual ones that we have here are 60 months and 84 months, right? And then you're looking at net qualified assets. What do we mean by net qualified assets? Well, that's where you'd have to look at the guidelines and see how they treat whatever you're using, right? The money market, the checking account, the savings account, and then if you have stocks, and then if you have retirement accounts, all of the, savings, checking, and money market, those will always be 100%. Now, stocks, bonds, mutual funds, that can vary. It may be 100%, it may be 80%, or maybe whatever, but it definitely is not always 100%. 401ks also usually, or and other retirement type accounts, could be an IRA, whatever type of retirement account, which is a restricted account where you put your pre-tax dollars in there so that you create more wealth based on the pre-tax higher amount of money, right? Well, those usually will have a percentage restriction that you can use, because the logic there is that the withdrawal from those accounts is usually restricted. And when you do withdraw it, unless you're a certain age, you're going to get hit with a tax bill, tax liability. And in some cases, if you withdraw it even before the age you're allowed to withdraw, then they'll also hit you with the withdrawal penalty on top of the tax bill. You got to pay a percentage. So due to that rationale, there's going to be a percentage hit. I guess we would call that a haircut applied to those accounts. But let me give you an example here of our $1 million person with asset, right? So a million divided by 60 months is $16,666.67, right? That's the formula to calculate at some of our more popular.
And that's for monthly, 16,000 monthly.
Yeah.
That's an insane amount. Yeah.
That's a good amount of money right there to just show it, not have to pledge it, which is another very important part of this equation. People get scared if they have to pledge that money, which means basically set that money aside and not touch it, right? Because then where are they going to pay from? It would not make sense. So, and now if we get the same example, and one second, and we run it by 84 months, right? So our same $1 million, just to give you a little context, divided by 84 months would be $11,904. Still nothing, to scoff at. But when you're looking at the options on where to select for the guidelines, you got to take this into consideration, right? I mean, there's quite a few moving pieces here when you get to this part of the puzzle, which is basically what asset types are you using, and then what is the number of months that they're dividing by. Now we have another interesting one here, one that you may not have considered, which is the total asset calculation method, right? So in this method, there is not a debt ratio calculated. They simply get the qualified assets, and then you just divide it. So you would get the total that you need to cover the down payment, the closing costs, the required reserves, plus 5 years of that borrower's current monthly obligations. That would include the total housing expense on the property that they're buying, qualifying for, plus their other debt service. So, whatever that is on a monthly basis, multiply that times 60. And if they have more money than that amount, then you're good. So there is no debt ratio at that point that's calculated. So if they needed, if that figure was $1 million and they got 1.1 million right now, then they're good. But just remember though that it's going to take into consideration all of the money that they need for the transaction, plus the 5 years of the monthly payment. So really cool option there. And then I mentioned previously, but the other, and I showed the example where the supplemental income calculation for a non-QM option when the DTI is 60% or less, because most of the non-QM options are going to have maximum 50% DTI. So if you're at 58% or whatever, well, whatever monies is left over after the down payment, after the closing costs, and after the required reserves, whatever that money is left over that they have available, divide that by 36, and that's your supplemental income. So considering that this particular option can be used with an option that we have, that now get ready, because it's like a bunch of different options that you can combine. This is when you get really creative, but this is what we're about at the Mortgage Calculator. You can get a borrower that you're using, let's say W-2 income, traditional full doc, because they have a W-2 job, but they also have a business that they get bank statement income from. They can have another business that you're using P&L income. And then on top of that, if you're still a little bit short on income, you can use the excess money that they have to help put them over the top. So heck, if we can't get that borrower to qualify with all those income streams, then we may just be out of gas there. But that is a very cool option there that we can use. So tomorrow we'll be getting into more specific scenarios when we're talking about structuring different types of deals, where we'll be displaying actual incomes, assets, and qualifying ratios, interest rates, FICO scores, all that kind of stuff, to give you an idea on what are the different scenarios, which I was just alluding to a couple of them right now. What are the different scenarios where you would be able to use asset utilization to be able to qualify your borrowers? Because I know we just recently had a loan that closed on a CDFI with the borrower getting paid in stock options, where I'm thinking maybe that would have been a good one to have tried asset utilization on.
All right. So great program there. As I said before, a great tool to have in the tool belt, right? You got a borrower you can't figure out what to do, but they got money in the bank. I mean, this is a perfect program. I was joking around with Jose earlier saying this is a program where you show me money and I'll loan you money, right? The great part about it is they don't have to pledge the assets, right? So you have a borrower with strong assets, then this is definitely a program to look at. With that being said, we will get more into this tomorrow, as Jose said, some more in-depth examples there. And I don't see any questions here.
We have one question.
I didn't see it. Oh, there we
It
go.
says, can we combine lease agreements and W-2 income with asset utilization? And is there an age restriction using this program? Well, let me answer the easy part first. There is not an age restriction using the asset utilization. There is an age restriction for the version that I stated is the Freddie Mac version that lets you use asset utilization for borrowers 62 years and older. So that one does have an age restriction. Now, the supplemental income for non-QM does not have an age restriction. Now, when you're talking about combining income, now W-2 income, like I just mentioned, yeah, we can combine W-2 income with bank statement, P&L, and asset utilization, or you can do a combination of any of those. But now, when we're talking about lease agreements, that is a different topic. We don't really have a lease agreement option that is a full doc option, and by this I'm talking about using bank statements or P&L or stuff like that. The only option where you could really use a lease agreement solely as the lease agreement without having to document it, for example, with bank statements on a bank statement program where you'd be showing the last 3 months of deposits from a lease agreement in the bank statements. You could use that if it's a bank statement option. But on a DSCR loan, that's I think pretty much the only one where you'd be using just the income from a lease agreement. And then that would not be the personal income of the borrower. That would be a DSCR, debt service coverage ratio loan, where you're using the income generated by the property, rental income generated by the property, to qualify the borrower. So that's the only scenario, and I don't think that can be combined with asset utilization that is using the personal income of the borrower. They would contradict each other.
All right. Okay, I think we can go ahead and wrap it up then. Again, tomorrow, tune in 7 p.m. Eastern time while we go even more in depth into this topic. Remember that we do this every Tuesday and Wednesday at 7 p.m. Eastern time, where we do a different training on a different loan program type or sales trainings and stuff like that as well. So make sure to tune in. Thank you, everybody, for the comments and tuning in. Thank you, Nick. Thank you, Jose. And we'll see you all tomorrow, 7 p.m. Eastern time, for the next loan officer training series. Everybody take care. Have a good night.
Thanks, everybody.
Thank you, everybody. Have a good night.